I think after all the storytelling sessions, finance is a bit of a boring one. But in many of the cases, we don't have a choice. I mean, when you have to run a business, then fundraising becomes very important at some stage in the life cycle of your company. And that's what we are here to discuss about on there. I think previous session, Priyanka just asked, what is the right time to raise funds? And should you really raise funds on that? I think let's, take a quick tap on that. Fundraising comes with a lot of responsibilities on there. On one side, then you are accountable to someone else. Today, while you're running your own business without raising funds, you can run your business the way you want. Today, you don't want to do anything. 6 months, you want to take a break, fine. But when you raise funds, then, you are responsible to give a handsome return to someone on that. And hence, that comes with that responsibility, monthly, quarterly reporting of, your business operations, key decisions you have to discuss with the investors. So that becomes very important. So whenever you want to raise funds, just have that thought in mind. Do I really need to? If you're very clear about it, that you're required, without this, you won't be able to go from this level to the next level, then yes, then go about it. Your first round of fundraise typically happens with friends and family, like she said, 4 Fs on that. And, then when you go for your first organized round is when angel investors or angel networks come in. And I will talk, more from angel investments, seed stage, pre-seed stage, how to craft your story, how to pitch to these investors on there. So that's what, we'll talk about. Before that, just one piece. Any idea when, early stage investors, what percentage of their investments are successful? Yeah. So that's the range. If you just search percentage of startups who fail, then it's 90% of the startups you will come across, 90% of the startups fail. And hence, when you pitch to these investors, keep that in mind. They will look at a pitch with that lens. They want every investment to become that 5% on that, because that is what makes up for the balance 95. As an angel investor, when I invest in about 15 to 20 startups, let's say 20, 15 startups fail. 2 would give my capital back. Another 2 would give me a 3 to 5x. And that 1 gives me anywhere between 30x to 100x. Unicorn. You would have heard about the term unicorn. And when an investor looks at every pitch, he wants that one to be the unicorn, to give him that 50x to 100x return. And hence it becomes extremely challenging now to pitch to those investors when they are looking or expecting that kind of returns from your startup. So let's keep this in perspective and then look at the pitch. And very simple pitch. Most of the investors today are used to looking a very, standard pitch, which is there. And we'll just touch upon that. Very simple on that. But of course, keep in mind that they invest in 0.5% of the startups they look at. Shivangi just mentioned, they look at 400 startups in a month and would probably invest in 2 to 4 startups. And that's the story with every angel network, every venture capital firm, every angel investor. So that's where it is. Now, pitching with purpose. So what are you pitching about? Your pitch to an investor is about your product or about your story on that. Always, start your pitch with a catchy tagline. Your first slide, don't waste with just the name of your company or the name of your brand or thing. Have a very catchy tagline. Okay. I help or we help X with Y by doing Z. Okay. Let's say any digital marketer here? Okay. Yeah. So your example probably, okay. I help brick and mortar companies multiply their revenue X times by helping them selling their products online on there. So helping them advertise their products online. So by that, when you start, you have to some extent gained the attention of the investor on there. And he knows what the pitch is going to be about on that. So that should be, I help X, with Y doing Z on that. Now, just moving on, then there are 7 to 8 standard slides or standard conversations. First is about the problem statement which you're solving. About that, be very, very clear about the problem statement so that the investor can connect with it. That's the problem statement. Okay, let's go back to Netflix when they started. Okay, there was a company called Blockbuster. This is 20-30 years back, which used to, and in the age of CDs. Okay, we used to go to, customers used to go to the store, pick up a CD, watch the movie, then go back and return it to the store. 30% of Blockbuster's revenue came from late fees. Okay, serious problem, right? So what did Netflix do on there? Netflix said, okay, fine, we will deliver and we will collect from your home. So they solved a big problem. Okay, and previous thing, I think TTT spoke about 3 circles on there. Is it your problem? Is it someone else's problem? Or further? That is what you have to connect to the problem. You have to explain that pain, the problem statement of yourself or someone else's very clearly. Let the investor connect with the problem. This is one very important part. Is the problem real? How big is the problem? How are you solving it? Is the customer willing to pay for fixing that problem? Have you tested that problem on there? Have you faced that problem actually on there? And just, then have some pictures, have various images, videos to show the extent of that problem. Now, this is where you need to establish the connect for him to go further. Then, if there is a problem, then there is a solution. So that's the second part of it. So again, very clearly, how are you solving that problem? Be very clear, concise, and focused. How are you solving? What is your product? What is your service? If possible, give a demo of that product on there. Priyanka asked a question to Shivangi. Have you come across your pitch where immediately you were impressed with that about storytelling, the solution? There was a company called Quaddy, which they changed the name later to Oga, which we came across. This was 3.5, or maybe pre-pandemic, so maybe 4 or 5 years back, we had come across that. So online classes were catching up. So this was about online yoga, online dance, etc., everything. And it would track all your movements. When you're moving, it would track your movements and show you a red. If it's green, which means, your move is perfect. If it's red, then it'll tell you that that's where you're going wrong. Excellent. What did he do? He just started it, and it was just a video. He just started and showcasing the product itself on there. After the pitch, all of us were like, forget due diligence, we want to invest. When can we invest? That was the kind of impact. So that is the impact you have to create with your solution on there. So that's about it. Again, in your problem, show various figures as to how big is the problem, how deep is the problem. When it comes to solution, show. If there is an app, show an image of that. Let's say solution about Ola or Uber. What does it say? One tap, your cab gets booked. You can track the journey. You know the fare about it. You know what time will you reach. Very simple. Then show, how does it look at that? How much time will it take for the cab to come? Very simple solution explained, and connect has happened with the investor on that. Then comes traction. What has been the traction? Third, problem, solution, and after your launch, what has been the traction? There you need to give, some statistics about it, some metrics. What have you been able to achieve? How many app downloads, or how many customers have you onboarded, or how many accounts have you won? How has it been? Is it doubling every quarter? Is it tripling every quarter? That's what 10%, 20% growth early stage investors are not interested in on that. So that is the impact you have to make when it comes to traction. That is the slide. And again, graphs, images work really well, and calling out specific metrics on that. Then coming to the fourth point, what is the unique value proposition? Tell me when it's half time. If anyone's timing, just tell me so that accordingly I can. Yeah. Unique value proposition. Why are you best suited to solve that problem? What is that unique value proposition on there? Is your team, is your product the best? Is your solution the best? Many would be doing that. Compare the features of your product, your services with the other competitors, because there would be competitors. If not, then Google and Facebook can easily solve that problem. So, if that it is, because every question I have seen where, investors ask, why can't Facebook do this? Why can't Google do this? So, that you will have to answer whenever you're going to an investor or any big company, why can't it do that? So put down your features very clearly, typical slide on every deck, green and red, which is there. This is your product solving, all greens on there, and others are green, red. So this is what you need to look at. What is the unique value proposition? Any guesses what comes next? The business model. Yeah, great problem to solve, great solution, good traction. You are the team to solve it, or yours is the product. What is the business model? That is the fifth slide. Where will you make money from? On there. How much money will you make? On there. So it has to be, you have to give 3 to 5 years of projections. What is going to be the losses? What is your cash burn on this? How much will you be losing every year or every quarter or every month on that? Unit economics, because every time you go, investor will ask you unit economics. Is how do you make money? So there is revenue, then there is direct cost, then there is contribution margin or gross profit as you call it. Then there is marketing cost to acquire a customer. Then comes contribution margin 2 on there. Then comes your salaries, G&A expenses and everything, and then it is EBITDA on that. So CM2 just a bit complicated, but I'll leave you unit economics. If you sell a product for 100 rupees, how much are you going to make effectively? Okay. In the early stages, you may make a loss. So then on that sheet, you have to tell them at what scale, at what stage will your unit economics turn positive. Your cost of acquisition may be high earlier, but as you go forward, it will be a mix of organic plus marketing. So your average cost will go down on there. When you do at scale, maybe your cost of production might go down. So at what stage, at what volume will you make profit? That is one very important aspect to cover in your business model. Okay. After the business model, then comes one very important piece. Again, why are you facing that investor? For funding. Again, so be very clear, how much funding do you need? Typically, we have seen, startups actually mentioning much more than they need. And they're saying, itna bolenge to itna to mil jayega. It's not about that. Be very clear that this is the funding I need on that, and what will help you achieve. With that funding, what will it help? It will help to reach 300,000 customers. It will help to get 500,000 downloads. So be very clear as to what is your goalpost. What are the metrics which will be achieved with that funding? Then who are the other co-investors? If you've already raised some funding, have you received soft commitments, or you've already had investors? So cover that on the funding slide. Existing investors in that. Now coming to the most important slide. Who's going to do this? The team. Because as investors, situations will change. But this is the team who will be responsible. So the most weightage as investors we give is to the team. Who's going to solve this problem? And that is where you need to clearly explain. Is there a mix of functional plus operational expertise on that? Different backgrounds? Who is going to be the CEO? Who is going to be the COO? Who will take the final calls on that? Are there any advisors you have on your board who are helping you to achieve your goals on this? Then who's the team? If you've already onboarded some team members, talk about it, because you alone can't achieve. Now here is, I don't want to go deep into that, but when there are women founders, then it goes a one step further of due diligence on there. Priyanka mentioned earlier that, is it for real? Yes, but on that. So single founder, red flag on there, clearly. Because in your journey, anything happens tomorrow, you fall sick, you go on a holiday, company has to run. So when it is a single founder, be careful, then we do double the due diligence. It has to be a really good idea. He should have really good traction. Only then would we choose to invest in that company. So these are the aspects, but team slide is very important. Give background, give logos of companies where you worked at. Then if this is the team, why is this team the best suited? Has to be explained on that slide or talking to the investor. That, okay, if I'm launching a media tech product, then I say that I have 20 years of experience in media. I have done TV, I have done digital, then I have done print, etc., everything. So I understand all the medium. I know how customer behaves on that particular segment. Then they say, okay, fine. Now I think he has an understanding of that space. He has on the ground seen that on that. So that carries much more weightage. So that slide is the most important. Talk about it, in detail. And that is where right to win comes. After all this, what is your right to win? Why would, any investor fund you? And you have to explain them that why can Jignesh do better than Priyanka in that space on there? That is what he would look at. So right to win is very important. You will come across these terms, and then there are many terms. But what is your right to win? You have to summarize your pitch with your right to win, considering who the founding team is, how solid the solution is, how big the market is, how deep the problem is. And considering all this, this is what understood best by this team, and this team has that qualifications to reach from this stage to the other stage. So that's your right to win, and that is when your possibility of funding comes through. Then, of course, there are various other slides. If you look up, on the internet, Ratan Tata's office has published a list of 16 or 17 slides that covers all these points on that. But the key 6 to 8 slides is what we discussed about with an investor, and that is what increases your chances of funding. Again, go back to TTT slides about be concise, be very clear. You would be pitching, once you have decided to raise, you will be pitching everywhere. You should have a 1 minute, pitch ready. You should have a 3 minute pitch ready. You should have a 10-minute pitch ready. You should have a 20-minute pitch ready. 20 is the max generally whenever you pitch on that. So that is what you should be ready. In a minute also you should be. In fact, 100x.vc co-founder Sanjay Mehta had did that in the BSA building, ground floor to 20th floor, pitch your idea and get funded. So, that kind of concepts are also there. But that's what you have to be ready with. Thank you. Thank you so much.